All right, Yield Nerds, episode 169. This time I am going to dress up very nicely like all those gentlemen there and start looking for stocks in the financial sector for various reasons, and I will explain why in a couple of minutes. Well, we're up to 479 subscribers. We have several playlists. If you're new, please use the roadmap playlist. That is the easiest way to get acquainted with the show. And there are a couple of others, preferreds and municipals and so on. But most importantly, remember to do your own research. I am sharing my education. Well, four parts as always. First, we'll take a look at the market temperature and how my portfolio does compared to the general market. And then I'll start going deeper into my research on the financial sector. All the links to the articles quoted in this article or in the description of this video. And I will review the algorithm I use to search for financial stocks and share which ones I own. Well, my equity portfolio is returning 5.75%, something like that over the last 3 months. However, I cannot compete with the NASDAQ. As you may remember, the NASDAQ had a giant dip and then it came roaring back. And I was not smart enough to sell everything I had and put everything I had into the NASDAQ. That's not how I roll. So I will look worse than the NASDAQ for at least 4 weeks is my guess, and then we'll see how it goes. I'll try competing. Well, my current portfolio allocation, as you can see, is continuously increasing. I'm almost up to 3% in equities, and that's not a lot for the average person. But for me, I started at 0.25%, and I'm using my own methodology to increase my allocation. And if it's returning 5.75%, I'm pretty happy with it. Well, how do I allocate? As you saw, I have a roughly 3% in stocks, almost all of it in US stocks. And in fixed income, I have about 67% in treasuries, but I am allocating a whole lot more into municipal bonds. And I've talked about that in some previous episodes. And I'm increasing my allocation in US stocks and starting to enter international stocks. Specific to this particular episode, I literally had nothing in financials, and now 8% of my equity allocation, please note that it is 8% of 3%. So 0.25% of my total allocation and 8% of my equity allocation is in financials now, and I'll share with you how I thought about it and why I got it. And now, the financial sector itself, there is a lot going on, and that is me trying to pick up the diamonds from the dirt. Dolly, you're making me pick up the dirt. You're missing the point. But I'm going to look for diamonds in the rough, so to speak, just in the financial sector, and I'll explain why in a couple of minutes. Before I go any further, I want to make sure you know that this is not tax advice, it is not investment advice. I'm sharing my education. I'm not a wealth management advisor, and I'm not here to preach politics or sell snake oil. Well, there was an article that talked about, what is the Federal Reserve doing and what are its choices? And I thought that was a very good article. The link is in the description. And the key takeaways kind of summarized it as, hey, you know what? The rest of the year may have a little bit of a downgraded outlook, while at the same time, there may be slightly higher inflation, slightly higher unemployment. That is the textbook definition of stagflation. And, there probably will be some rate cuts. However, we're looking at a stagflationary economy. And when you read that, it means certain things. And, this article doesn't have to be right. It is one position. So I take things like that and start looking at what are the most likely next steps. Well, the very first thing, whether you like it or not, Secretary Bessent has the opportunity to start doing quantitative easing. You may remember, I mentioned this in a couple of episodes ago, that he actually bought 10 billion of treasuries. Now realize he has to sell 1 trillion. So he really shouldn't be in the business of buying it. But all I'm trying to say is whether, Bessent wants to do it or not, we got a big amount of debt to refinance. That's about 1 trillion of it coming due, and that has to hit the markets. Now, if you're going to go refinance, would you refinance at 5% or 3%? The answer is obvious. You would refinance in the lower areas. However, here is the challenge. The low end of the curve is at 4.5, 4.25%. So there probably is going to be some amount of attempts to try and drop the rates at the very low end of the curve, because all that Besant needs to do is borrow money between now and next year when there will be a new Fed chair, and odds are the new Fed's chair would be a little more dovish, and you make your decisions on whether that is good or bad for the economy, but those are the odds. So if all I need to do is bite through the bullet and get through a year before interest rates drop precipitously, then I'm going to try and sell more of it short term. Well, if 1 trillion shows up short term, there may not be enough buyers, and that means the short term yield may actually go up, even though they're trying to get it down. So there's some very interesting things going on there. The next part in all of this is if you need the banks to suddenly put another trillion in their balance sheet, well, they need to be able to lend against it. So you can read through the press. There are some things that are being done to say, hey, banks, if you buy our treasuries, you can lend more on that basis, even if they are underwater. And that's a very interesting way of telling the bank, would you please, pretty please, buy more of our treasuries? And the reason you would do all of this is because you have a problem. You have to refinance debt. You don't want to refinance it at 4.5% long term. If you take that trillion and you put it on the 10-year, then you got a big problem. That is going to go higher and higher. So there is a little bit of a chicken and egg thing that the government is going to try and do. So you tell the bank it's okay, keep more of our treasuries. You try to lower the initial side of the curve. You try to get Chairman Powell to do it. If he won't do it, you create a lot of ruckus and you try to decrease it. If none of it works, you make it, you try and do some quantitative easing, however you can do it. The one thing which is unlikely to happen, now it may happen if we don't have a choice, but I doubt that the US is going to provoke more geopolitical problems because that doesn't help, because other nations will have to buy our debt as well. 30% of our debt is held by foreigners. And you may see in the press that the bill that is in Congress, the revenge tax is foreign countries, being taxed to hold our debt. That has been removed. And that is a way for us to say, whoops, didn't mean to do that. Would you please buy more of our debt? So what does all of this mean? If we print more money, the dollar is going to depreciate. Interest payments are going to increase no matter what because we don't have new money coming in. Inflation is likely to increase whether you print more money or not, or you issue more debt. And so what would you do if you know the dollar is going to depreciate, interest payments are going to increase, and inflation is going to increase? That is really what should inform your strategy. At least it informed mine. I'll tell you what I'm doing. I could sit here and say I'm going to over allocate short term treasuries on the bill side, which I am doing, but it has a risk. The risk is that when that 6 month or 9 month matures, if the short term interest rate is now 3%, well, instead of making 4.5%, I now can only make 3%. Now I got a problem. Now, however, the reward is if the market crashes between now and the next 9 months, I have a lot of dry powder. Well, I'm leaning a little bit into this market crash scenario. It doesn't seem to be happening, but I am leaning in there. That's why 2/3 of my portfolio is in the very short term. However, I'm slowly taking it out of there and putting it into munis and some amount of equities, although 3% is hardly an allocation. The next thing is I can stay within the treasuries and maybe buy the 10-year. The challenge is if all of a sudden there needs to be a huge amount of debt that is issued, then the yield will increase and not decrease. I would rather buy a 10-year at 5.5% than a 10-year at 4.5%. And you would too, I would imagine. And so the risk is that if you bought it now, you may get strapped with a lower yield. The reward is maybe the opposite happens. Maybe the new Treasury Secretary next year, somehow, I don't know how, drops the entire yield curve, and you are the lucky, wonderful guy who happened to own the high yield long-term debt. I don't have a crystal ball. I wish I did. I do have some agencies that pay 6%, which are 10-year and 20-year. But I'm betting more on the munis on this side than the treasury. So I'm not buying the 10-year, but I am allocating on the longer duration side on the munis. The last is, it should say binge buy, not bing buy. I could binge buy equities if I came to the conclusion that, you know what, we are going to have a wonderful bull market and we're not going to miss it. And I'm not counting on that as much. I mean, I am increasing my equity allocation, but it's not 30%, it's 3%. Unfortunately, I do think with the debt load and the interest rate issues and money printing and stagflation, I think I'm probably going to look at a better deal, a lower stock market at the end of the year. But I could be wrong, and that is why I have 3% equities. I might buy a little more depending on how it goes, but I'm not going to binge buy equities. This is my assessment of the risk and rewards. So what is my strategy? In very simple terms, wait and see. I'm going to keep a whole bunch in short term. I am decreasing taxes, and I'll buy what I call must-have equities. Equities that service staples, equities that service energy sector where, it's utilities, things like that. But financials interest me only because we have this massive amount of debt that is coming for refinancing the rest of the year. And the government will be kind because they have to be kind to the financial sector. And my guess is if you really give a sweetheart deal to the big banks, the JP Morgans and the Bank of Americas, then they're going to have extra cash to do something with. And the do something with might be buying smaller banks, regional banks. And so I'm looking in that sector. I'll share with you what I found. The next thing is international markets. If we print more money, then the currency is going to depreciate. If the currency depreciates, dollar denominated international stocks will appreciate. And I'll talk to you more about it in the next episode. So here is where I think the result would be. I'm looking for small banks in the financial sector because I think the government is going to be very gracious to the financial sector, give them some spending money. But I am going to stay true to my filters, the growth filter and the value filter. And I've reviewed them before. We'll take a very quick look at them. So let's get to work. Let me shovel away these nickels and quarters and look for that diamond in the financial sector. You may remember the growth filter looks like this. It says, give me domestic companies that have a really large market cap and they are held widely and they grow at 20% plus, which is phenomenal in the last 12 months. And their price is also increasing, but their price is increasing slower than their revenue. And they don't have a lot of debt. The PE ratio, we'll take a look at what the PE ratio is, and I need it to be in financials. And this says, here you go. These are the two that qualify. Are you ready? Drum roll. Who are the two? And they are Robinhood and NU Holdings. NU Holdings has a P/E ratio of 30, Robinhood at 48. And why would that be? Who are these people? They are both widely held, 70% plus held by institutions. Look at that revenue growth, 60% and 30%. And they don't have much debt. And so let's get to know them. All of you, or at least most of you, I'm sure have heard of Robinhood. They've had a storied growth in their stock price. Their revenue has also gone up quite a bit. The question then is, why Robinhood and why now? Earlier this year, there was a rumor that Robinhood would make it to the S&P 500 and the NASDAQ 100, and they did not. And why they did not, I couldn't tell you. But the way their stock is growing and the way their earnings and revenue is growing, and unfortunately for the rest of the market, they are not keeping pace, there's a pretty good chance Robinhood would be included in the index rebalancing next quarter. What about NU Holdings? And I had to educate myself in this. This is not a US-based company, so this is a double whammy for me, or a double opportunity for me. It's an international equity, and they are in financials. They are kind of like the Amex of Brazil, if you will. So they are a credit card. They give loans, and they are spreading like wildfire in South America. And here is their equity price. It's kind of accelerated by 500%. And their earnings per share is just a beautiful linear line. They made some losses 2 years ago, and then it has been onwards and upwards. Their revenue has been going up every single quarter. Their cash flow has been going up every single quarter. And you go, I wonder what NU Holdings is about and whether I should buy it. So then let me go to the value filter. The value filter is different than the growth filter. The value filter says, hey, this time I'm interested in return on investment capital. I'm interested in profit. I'm interested in PE as well, but maybe there's a couple of percent dividend. I'll take it if it is there. Price to cash flow is extremely important. And also, I only want financial stock. And only one company qualifies as a value stock if you were to compare it against all the other industries. And you have to go, who is that one financial stock that is considered a value stock? Ta-da, it is T. Rowe Price. And it's an oddball, I will admit. They have good volume. Their return on invested capital is 18%, $11 cash flow, profit of 30%, no debt on their books, PE ratio of just 10, a very good coverage ratio, and look at that dividend, 5.3% dividend. And you go, really? Well, let me educate myself more on T. Rowe Price. Why is it so cheap? And you start looking at them and understanding, I wonder who else is doing it. They have pretty good volume. You can see it's 400,000 a day. Whoa, you look at their stock price and it looks horrible. It has been burning and crashing all the way, and it is, if you look at their peak to trough, it is more than 60% fall from grace. And you have to say, well, why is it doing that? Well, T. Rowe Price, as you know, is in the industry of advising people, wealth management advisors. And you know what I think about wealth management advisors, and I don't mean that in a facetious way. If you have one and you like them, that's wonderful. Um, Earnings per share for T. Rowe Price has been pretty consistent. They kind of keep creating mutual funds, and if you read their 10Q, it says people are running away from our mutual funds because the fees are too high. So they turn around and create ETFs. ETFs have lower management fees, and if you have lower management fees, your revenue does not increase a lot. So T. Rowe Price, for all practical purposes, has stagnated. Their share price is crashing and burning. Their revenue is staying flat. Their cash flow is slowly decreasing. This is a very interesting opportunity for them possibly to be acquired because they're relatively cheap. They give a really big dividend, 5.28%. And so I kind of like what I see with T. Rowe Price. It's one of these cheap stocks. At least that's how it looks to me, even though the wealth management industry is not exactly the strongest one. So I will tell you, I've gathered all the diamonds in my shovel and moved all the nickels out. And so here is what I ended up with. There are a couple of other filters that I did not review. I do now own Bank of the Ozarks, which is a regional bank, and I'm hoping they will get acquired by somebody else. A very strong bank, in my opinion, very regional. North Rim Bancorp is only in Alaska. Again, a very strong regional bank. And so I kind of look for these regional banks that I'm hoping somebody will buy out. I own Interactive Brokers and Robinhood, so I'm betting on the casinos. And NU Holdings, we saw that. That's the Brazilian American Express, if you will. T. Rowe Price, I like the cheap value here. And Toast, I expect Toast sooner or later to join both the S&P and the NASDAQ 100. Look up their financials. So that is what I have in the financial industry. You do you, and thank you for watching Yield Nerd.